Welcome to the Deep Dive. We're here to cut through the noise of corporate earnings calls and pull out the key insights you actually need. Today, we're digging into Vital Farms, the ticker VITL. We just listened through their Q2 2025 results call, and the big story isn't just a good quarter.
No, not at all. It's more about how they're using that success. They're hitting the accelerator, really pushing an aggressive expansion to meet what seems like relentless consumer demand.
Yeah, that aggressive stance really came through. So let's start with the headlines, because, the numbers themselves were pretty impressive. A significant beat on both the top and bottom lines.
Definitely a beat. Q2 net revenue landed at $184.8 million. That's about $14 to $50 million above what the street expected.
Right, and represents really strong growth, too, 25.4% year over year.
And the profit side is maybe even more telling. Adjusted EBITDA, which is a good measure of core operational profit, hit a record for them. $29.9 million in the quarter. That's a 16.2% margin. And importantly, that grew almost 29% year over year.
Hold on, so 28.7% EBITDA growth versus 25.4% revenue growth. That difference matters, right?
It absolutely matters. It shouts operational leverage. They're scaling efficiently. As revenue goes up, profit is going up faster. Costs are being absorbed better. It's textbook successful scaling.
Okay.
And you saw that on the bottom line too. GAAP diluted EPS, $0.1136. Consensus was only looking for about $0.1127. So yeah, strong quarter all around.
Okay, so a strong quarter, clearly. Let's unpack it. Because this performance immediately led them to raise their guidance for the whole year. That signals confidence, doesn't it? Suggests this isn't just a one-off quarter.
Exactly. Management put their money where their mouth is, so to speak. They bumped up the full fiscal year 2025 guidance pretty significantly.
What are the new numbers?
Net revenue now expected to be at least $770 million. That's growth of 27% or more year over year. Previously, they were guiding to $740 million plus.
Okay, so a $30 million lift on the floor there. And what about profitability?
Same story. Adjusted EBITDA now guided to at least $110 million. That's up from the previous floor of $100 million.
And they didn't just, roll forward the Q2 beat, did they? They said this raise is driven by something specific in the second half.
Correct. They're banking on accelerating volume growth, partly because the supply issues they had back in Q1 are easing up.
Right.
But maybe more importantly, they said consumer demand is holding up really well, even after they push through some price increases mid-quarter.
That's always a key test to brand strength, isn't it? Raising prices and seeing demand stick.
Absolutely. It shows they have some pricing power, some brand loyalty, and they actually project volume growth will pick up speed sequentially through the year. Q4 is expected to be the highest volume quarter.
Q4 being the peak always requires strong execution. Why the sequential ramp? If demand is strong now and supply is easing, why wouldn't growth just be high consistently?
Well, it's probably a mix of things. They're still fully ramping out of those Q1 constraints. And, managing that growth takes effort. Look at the gross margin.
Yeah, what was that?
38.9% for Q2. Management pointed out it was actually down slightly year over year.
Oh.
They said it was planned due to investing more in their crews, getting ready for the volume jump, and some, let's call it, less efficient operations while they were still supply limited. The real profit driver was the revenue scale and getting those price increases through. But they need that back half volume acceleration to hit the raised profit numbers.
Okay, that makes sense. Which brings us to, I think, the real headline from this call. The capacity flywheel, as you called it. The CapEx surge.
Yeah, this is where it gets really interesting. To support the demand and that higher outlook, they are just massively accelerating capital spending.
How massive are we talking?
Okay, so the original FY25 CapEx plan was $50 to $60 million. The new guidance, $90 to $110 million.
Wow. So they're potentially doubling their planned spending for the year, pulling forward maybe $40, $50 million.
Exactly. They're deciding to spend that extra chunk now.
Isn't that risky, pouring that much extra cash into projects so quickly? What if that Q4 demand spike doesn't quite materialize as strongly as they hope? Seems like a big execution bet.
It's definitely a bet, a calculated one. But they laid out the strategy. It's very targeted. They're essentially doubling down on the new facility they're building in Seymour, Indiana.
How so?
The original plan was, phase in the production lines there. One, then maybe another later, now. They're installing 2 lines simultaneously, right from the start. They want that capacity up and running ASAP.
And the payoff for that speed and upfront cost?
Huge potential scale. They project that Seymour facility alone will provide over $900 million in annual revenue capacity once it's fully operational, which they expect by early 2027.
$900 million from one facility. That's quite something.
And check out the efficiency metric they threw out. They're projecting more than $5 of annual revenue capacity for every $1 they invest in CapEx at Seymour.
5 to 1. That's incredible capital efficiency, isn't it?
It really is. It suggests their premium pricing and sticky demand allow for unusually high returns on these infrastructure investments. That's how you build a competitive moat. They seem very confident in that number.
And it's not just the new place, Seymour. They're also boosting capacity at their existing hub, right?
Correct. Springfield Egg Central Station, their main facility, ECS. They're on track to bring a third production line online there in Q4 this year.
So more capacity coming online even sooner.
Yeah, that third line alone is expected to boost their current capacity by about 30%. So they're squeezing more out of what they have while building the future mega plant.
And they also talked about optimizing the flow of eggs, not just the processing, something about cold storage.
Yes, this is a smart, often overlooked detail. Logistics. They're moving away from relying on, third-party storage or long truck routes between processing and storage.
Okay.
Instead, they're building purpose-built cold storage right near the Springfield ECS. And for the new Seymour plant, the cold storage is planned to be literally adjacent, like sharing a wall.
So cutting out transportation time, cost, and potential issues. Makes sense.
Exactly. Less handling, less trucking, better control. It streamlines the whole operation. It's a move towards more vertical integration of their logistics chain.
And the supply side feeding into this, the farms themselves.
Still growing. Over 500 family farms now, roughly 9 million hens in the network. And they mentioned these accelerator farms.
What are those?
Kind of like R&D farms. They test new processes, maybe different feeds and new technologies on these specific farms first. Then, once something proves out, they roll it across the whole network. It helps the entire system improve quality and efficiency, not just get bigger.
So putting it all together, the farm network growth, the accelerator farms, the new lines at Springfield, the mega plant in Seymour with integrated cold storage.
It all points to one thing, that $1 billion revenue target they set for 2027.
Yeah.
They explicitly reiterated it on the call. This whole capacity build-out is designed to make that target achievable.
The narrative really shifted then. It used to be, can they get enough eggs? Now it seems to be, can they build fast enough and execute flawlessly?
That's precisely the pivot. It's all about execution now. But we should talk about the potential bumps in the road, the watch-outs. Management was upfront about some expected margin pressures in the second half.
Right. Important context. What are those pressures?
3 main things. First, the impact of U.S. tariffs on some imported goods. They expect that to hit mostly in Q4.
Okay, external factor. What else?
Second, more promotions. Now that supply isn't as tight, they plan to increase promotional activity back to sort of more normal levels.
Standard stuff for a growing brand, trying to keep momentum.
And third, just generally higher marketing spend. They specifically mentioned a new ad campaign connected to that show, FX's The Bear.
Okay, so tariffs, more promos, more marketing. How big a deal are these? Management seemed to suggest they're already baked into the higher guidance.
They did stress that, which, helps limit the risk of a negative surprise if they're right. But it does put even more pressure on hitting that accelerated Q for volume growth.
Because the volume needs to be strong enough to offset those headwinds, basically.
Exactly. If that Q4 volume ramp is even a little slower than projected, those pressures, especially the tariffs, could bite into the bottom line, even if revenue hits the target. It tightens the margin for error on execution.
And what about funding all this? That massive CapEx jump. Does it strain their finances? They mentioned free cash flow would go negative this year.
It will push FCF negative, yes. That's the direct result of pulling forward $40–50 million in spending. But, and this is key, their balance sheet is rock solid.
How solid?
They reported $155 million in cash on hand. And crucially, zero debt.
Zero debt. Okay.
So they can fully fund this entire accelerated CapEx plan internally. No need to borrow money or issue stock. That significantly de-risks the expansion plan itself, assuming, again, they execute on the build-out.
Got it. One last housekeeping item. There was that issue earlier in the year, the material weakness related to accounting controls for revenue recognition. Any update there?
Yeah, they addressed it. Said the remediation is on track, should be fully corrected by the end of this fiscal year, FY25.
And they clarified the nature of the issue.
They did. Emphasize it was a design deficiency. Specifically, they lacked an automated way to reconcile purchase orders with sales data. It's a process gap, not an error in the actual reported revenue numbers.
So no restatements expected?
Correct. No restatements anticipated. It seems like they've contained it and are putting the right fixes in place. Important distinction there, process improvement, not recalculating history.
Okay. So moving towards the wrap-up, this is not financial advice.
Definitely not. This is just us connecting the dots and thinking out loud for you, the listener. The big picture here, the key takeaway, is that shift we talked about, from supply scarcity to capacity scale up.
Management is clearly all in on building for that $1 billion revenue target in 2027, putting serious cash behind it now.
That confidence, pulling forward $40–50 million in spending to lock in potentially $900 million plus in future capacity, combined with the pricing power they showed, well, it makes you think about the long-term possibilities.
So for someone with a high conviction in their execution, what's a provocative thought?
Again, not advice, just speculation. But if you truly buy into the brand, that 5-to-1 CapEx efficiency and management's ability to deliver, you could consider something aggressive.
Like what?
Maybe a long-dated, deep-in-the-money call option, say a $35 strike, expiring out in December 2027.
Okay, why that structure?
It's a leveraged bet that they hit or exceed that $1 billion target, that the capacity comes online smoothly, and that the market rewards that execution by driving the share price significantly above where it is now, around $43. It's betting heavily on that capacity flywheel spinning up successfully. Pure execution play, high risk, potentially high reward.
Right. So wrapping this deep dive up, what's the bottom line for you? Vital Farms smashed Q2 expectations.
Yes, and more importantly, they signaled huge confidence by dramatically accelerating their infrastructure. Build out the new lines, the massive Seymour facility, the smarter logistics. They're building now for demand they see years out.
Demonstrating pretty robust execution so far, it seems.
Which leads to the key question for you to mull over. With the brand clearly strong and the money secured for expansion, does the main focus now just become defending margins against things like tariffs and competition? Or is the volume growth story so strong that it will likely overwhelm those concerns if they keep executing on this build-out?
Something to think about. Thanks for joining us for this deep dive into Vital Farms' latest quarter. We appreciate you tuning in and staying informed.